A Fortune 500 company borrows billions, pays almost nothing in taxes, and it's completely legal. The mechanism is called the interest expense deduction. When a corporation takes on debt, bonds, bank loans, whatever, the interest payments it makes are treated as a business expense. And like all business expenses, they reduce taxable income. So a company earning $1 billion in profit can borrow heavily, deduct the interest, and shrink its tax bill substantially. The system's been embedded in tax code for over a century. But here's the question: how did this particular loophole become so profitable for the ultra-large? Start with scale. A small business borrows $10,000 and deducts the interest, maybe $1,000 a year. The tax savings matter, but they're modest. A multinational corporation, though, it can borrow billions. And when you're borrowing at scale, the arithmetic changes entirely. A company with $5 billion in annual debt might deduct hundreds of millions in interest annually. That's hundreds of millions in taxable income simply erased. The tax savings compound. So why would any large firm not do this? The answer lies in leverage arbitrage. A corporation borrows money at, say, 5% interest. It invests that money in operations or assets that generate 8% returns. The difference, 3%, is pure profit, and the interest is still deductible. For decades, this worked beautifully. Companies could borrow cheap, deploy capital efficiently, and reduce their tax burden all at once. It's a feedback loop. Lower taxes mean more cash on hand, which funds more borrowing, which generates more deductions. But here's where the system starts to strain. What happens when the incentives get inverted? Enter the leveraged buyout era. Private equity firms discovered they could acquire a company using mostly borrowed money, load that debt onto the company's balance sheet, and then deduct all the interest against the company's operating income. The company pays the interest. The deduction shields the profits. Suddenly, interest deductions weren't just about financing operations. They were about financing acquisitions while minimizing taxation. The firm that gets bought is now servicing debt it didn't originally incur, but the deduction benefit flows to whoever owns it. This created an obvious incentive: borrow as much as possible. What guardrails existed to prevent this from spiraling? Theoretically, lenders themselves are the guardrail. Banks won't lend infinitely to a company because default risk rises. A company drowning in debt becomes harder to finance, but that assumes rational lending. In practice, especially during boom cycles, lenders compete aggressively to underwrite deals. Credit markets loosen, covenants weaken, and suddenly, companies that should never have qualified for billions in debt are carrying it. The deduction incentive meets loose credit, and the system accelerates. By the early 2000s, some large corporations were carrying debt loads that would have been unthinkable a decade earlier. So what changed in the tax code itself to address this risk? Not much for a long time. The interest deduction remained largely untouched. Some countries, Germany, for instance, implemented interest barrier rules that limit how much interest a company can deduct relative to its earnings. The US didn't instead. It relied on the alternative minimum tax, a parallel tax system designed to ensure even heavily deducting companies paid some floor amount of tax. But the AMT had carve-outs and was often circumvented by sophisticated planning, so the deduction persisted as a primary wealth concentration tool. Why? Because the corporations using it most aggressively also had the resources to shape the rules. This is where the political economy reveals itself. Large corporations fund campaigns, hire lobbyists, and contribute to think tanks that argue for the deduction's preservation. The argument is familiar. Without it, companies won't invest, won't hire, won't grow. It's framed as pro-growth policy. And for certain firms, especially those in capital-intensive industries, there's a grain of truth. But the deduction's beneficiaries are disproportionately the largest. Most leveraged entities, private equity-backed companies, highly financialized multinationals, real estate developers. The system concentrates wealth upward because the deduction's value scales with debt, and only large firms can service massive debt loads. Smaller competitors, unable to leverage as heavily, pay higher effective tax rates. So what's the actual empirical outcome of this arrangement? The data shows a clear pattern. Since the 1980s, as interest deductions became more aggressive, the effective tax rates of the largest corporations have fallen significantly. Some Fortune 500 companies pay single-digit effective tax rates despite billions in profit. Meanwhile, the federal government's corporate tax revenue, as a percentage of GDP, has declined. The deduction didn't disappear, it was reallocated. Smaller firms, unable to structure debt strategically, bear a proportionally larger tax burden. The deduction, in other words, became a tool for concentrating tax benefits among the largest players. It's not a secret mechanism, it's explicit in the tax code, but its true function, wealth concentration through debt incentivization, remains largely invisible to the public. And here's the final piece. Why has this survived so long despite being structurally destabilizing? Because it solves a problem for policymakers. When corporations are heavily indebted, they are motivated to remain profitable and avoid default. They hire, invest, and reinvest earnings to service debt. The deduction essentially subsidizes corporate borrowing, which fuels growth in the short term. Everyone, politicians, executives, lenders, benefits from the appearance of growth. The cost is externalized, reduced government revenue, increased inequality, and systemic fragility. When recessions hit and companies can't service their debt, the losses are socialized through bailouts or bankruptcies that ripple through supply chains. This is predictable. Economists saw it coming before 2008. They see it again now. The deduction isn't a bug. It's a feature of a system designed to prioritize growth and capital accumulation over tax equity or financial stability. So here's what we know. The interest expense deduction allows corporations to reduce taxable income by deducting debt service. For large firms, this creates enormous tax advantages. It incentivizes borrowing, concentrates wealth among those who can leverage most aggressively, and reduces effective tax rates for the largest players. The mechanism is legal, embedded in tax code, and defended by powerful interests. It's not hidden, it's in plain sight. But because it works through the abstraction of tax code, most people never see it. And because it produces growth in the short term, it survives politically despite creating long-term instability. The interest deduction is a window into how financial rules get written to benefit the already large, and how those rules become invisible through complexity and political protection. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you want to understand how wealth concentrates through legal mechanisms most people never see, subscribe. We break down the next system every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.